Okay, everyone. Thanks so much again for joining us. So we're going to be talking about the Springfield 2 portfolio. This is, again, our second portfolio in Missouri. So we've been calling it the Springfield 2 portfolio. And we'll, with it being our second one, it makes it even better offering for a lot of strategic reasons. So before I jump in, just wanted to show this confidentiality and disclaimer. So this is a private placement offering. So we have to follow SEC regulations. We actually file with the SEC. We have a lot of legal documents we work through with that. So as part of that, any kind of distribution of this has to be something we're involved in. So we will be putting this on our YouTube page. You're welcome to share the YouTube link with your friends. Just please let us know as you're sharing it, because it's something we're supposed to be in the loop on. And also this offering memorandum we'll share with the PDF version. Same thing, we just need to be in the loop as you're sharing it out. House rules. So we have Zoom webinar feature, which allows us to do Q&A in the Q&A tool. So if you've got questions as we go, just drop them into that Q&A portion. Makes it super easy for us to make sure we're answering everything and respond both through text as well as verbally. So please watch that. We'll answer all of them at the end, but there might be some we see throughout that we'll kind of bring in just because it's relevant to the part of the discussion. And we'll also send all of the questions and responses tomorrow out with the recording via email. So you can see transcripts of all of our answers. So quick agenda, we're going to jump into who we are. I think most of you looking at the attendance here already are partnering with us and have some background with us. So it's super comforting to see some people coming back and returning with us. In addition to that, we'll talk about highlights of this particular project, talk about the overview, why we like this investment, especially the market specifically, and then we'll go to our business plan for this portfolio. So quick background on us. So Ryan and I are the co-founders for Suncrest, and I really am more responsible on the finance and legal side and head up the acquisitions. Ryan is our operations guru, so all of the property managers ultimately roll up to him. He also oversees all of our home orders, infill, inspections, everything that comes with homes, because it's probably the most important part of our business is homes. Matt helps us out with asset management. He also does a lot of work on underwriting with me. And then Brennan is an awesome project manager, helps us out. And Allie, I think a lot of you already know Allie. She does investor relations for us. So she is fantastic and has helped us out with this deck tonight. On this project, we're really excited to announce that we are partnering with FTW Investments. This is the first time we've announced this. We haven't said this over email at all. I have personally worked with FTW Investments on a number of projects. They focus primarily on multifamily projects in Kansas City. So they're actually based in Kansas City, which is just over 2 hours away from the Springfield portfolio. This is such a large project that we did need to bring in another sponsor for a number of reasons, but they made the most strategic sense for us because we have a really long-standing relationship with them. They're close. They've got some really great experience in mobile home park space, as well as in multifamily, Kansas City market, Missouri market as a whole. So they just really made perfect sense. So they are Freeman Tuck Webb Investments is what the FTW stands for. They actually have a new podcast that they launched a few weeks ago, and Ryan and I were one of their first groups to be interviewed. So that was a lot of fun. So look forward to seeing that come out. But again, these guys are great. They're going to be really good partners for us. About us, just jumping in a little bit more. So to be clear, we're going to be the lead sponsors, the lead project managers on this. FTW will come in as kind of co-sponsors with us and we'll help out with some of the asset management. So just wanted to make sure that it's really obvious who we are. Talk a little more about that. So Ryan, sorry, do you want to go and jump on this?
Yep. All right. And here's where we are right now with our properties. The Springfield, Missouri Portfolio 2 down below is at the bottom is the one that we're going to be talking about tonight. So we have 5 mobile home communities in Iowa, 4 around the Des Moines area, and 1 in the Cedar Rapids area. And we have 4 existing parks that we own and operate in the Springfield, Missouri area. Rolling Meadows is down closer to Branson, if you're familiar with that area. But the other 3 are all right in Springfield, just minutes away from where these others are. We have 2 in Kansas and 2 in Idaho, where Brett and I live close to Boise, Idaho. All right, wanted to share that. So Brett and I in Suncrest, so we're Verivest accredited, which means, so Verivest, they put sponsors through a careful due diligence process and ongoing portfolio monitoring as well. And we as principals agree to quarterly, they have a code of conduct for sponsors that we've agreed to, and each quarter that we review and agree to. And so we've been vetted and verified through Verivest, so just adding an additional level of confidence for our investors.
So jumping into the investment highlights, I think this is always my favorite part of any of these webinars. So looking over this, we've got a 17% investor IRR. We specifically say investor IRR because we want to distinguish this is the IRR we're projecting for investors like all of us, right, that we're investing in the deal. So IRR stands for internal rate of return. And this is my favorite metric because it's the easiest way to compare apples to apples against other investments. So for example, if you own stock in Tesla and it goes up $2,000 over 10 years for one stock, but you invested 1,000 and it's now 2,000, that's 100% return on investment. But it's not the same as an IRR because IRR is over time. So even if you get cash flow over years or months, that can make a difference because it's all about that time value of money when you're getting the cash flow. So $1,000 a year from 10 years from now versus $100 per year for 10 years is very different. So that 17% IRR really is the best way to measure that. We have had some other projects recently that are above 20%, which has been really exciting. The reason we like this project so much though is because this project, as Ryan's going to get into, is already 90% occupied. It's in a market we know really well. So while the 17% IRR is a little bit lower than what we've seen on other projects, from a risk adjustment standpoint, this is the best returns we've seen. So we're really excited about that. We're also being, as always, we're very conservative with our underwriting. We've been conservative with cap rate assumptions on both refinance as well as sale, as well as our cash flow assumptions. So we're really confident with that IRR and actually expect to beat it. We plan to hold this for 10 years. We will do a cash out refinance at year 5, which will be a full return of equity. So if you invest $100,000 today, 5 years from now, we expect that entire $100,000 to come back. But for the entire 10-year holding period, you'll be getting cash flow from this investment. And when we sell the investment, you'll also get your pro rata share of that investment. So what that means is, looking at this third column, we're projecting a 3x equity multiple. So over a 10-year hold period, we expect you to triple your money, both from cash flow, from cash out refi, and from sale. It'll be a tripling of your investment. 8% preferred return. We have this beginning month 6. We did initially say month 1. We're confident in our cash flow. However, as we've looked more into interest rate risk, we think it's wise for us to pad back a little bit on when we start the distribution for 8% pref. Certainly, as we jump into the project, if everything is good and we've got interest rates are where we expect them to be, then we'll start that sooner. We're just trying to be a little bit conservative on the timing for that. And into the portfolio overview. I think, is Matt having trouble with his video?
He is. I have him on not ideal, but I have him on my speakerphone. So we'll see if you can hear it okay, Brett. If not, I'll let you take it over.
Sure.
Okay, go ahead, Matt.
Okay, so thanks, Brett. I'm really sorry about this. Ryan and Brett, can you hear me all right?
Yeah, yep,
Okay.
You sound okay.
All right. So good evening, everyone. I'm going to walk through an overview of the portfolio. I'm going to start off with the communities, kind of where we are now and where we're going. For those of you who have invested with us before, we've been investing in mobile home communities in the Springfield, Missouri metro area, which is just under a 3-hour drive from Kansas City, Missouri. Also, to the south of Springfield, we own a park that's right outside of Branson, Missouri, which is a popular tourist destination. Next slide. So we've highlighted our 3 communities in Springfield, which are Cedar Lane, and just 6 minutes away from that is Evergreen, which we had just acquired. And we also have Suburban Acres. And as I mentioned before, down near Branson is Rolling Meadows, which is probably our nicest park to date. Next slide. And now here in yellow are the 6 new communities which comprise the Springfield 2 portfolio, which we're looking to purchase shortly. There are 4 properties in Springfield, which are Spring Park Estates, Lazy Acres, Chestnut Gardens, and Cedar Brook. And just about an hour drive away up Route 44 in Lebanon, Missouri are the other 2 parks, and that's where we have Oakwood and Ivy Acres. Obviously with the stay on that slide. Obviously with this new portfolio, we can really leverage economies of scale. We've started to develop relationships in the city of Springfield and during due diligence and also during due diligence with Lebanon as well. We've already made a really strong regional management team that we can further leverage to cut down our costs and manage all of the properties effectively and efficiently. We're also, extremely fortunate to have a contractor in the area that's been essentially exclusively working for us. The quality of the work from the contractor has been excellent, and he's been able to grow his team and his business with our increasing demands. So we've really been lucky to create this win-win situation. Next slide. So at a very high level snapshot of the Springfield 2 portfolio, there are 465 lots that we're going to bring on. And this would bring our total lot count to just under 700 lots in the Springfield metro area. Currently, the portfolio is 88% occupied. So, obviously this won't be a super heavy lift for us in terms of infill. Another potential bonus to the portfolio is that there's some extra land that is attached to the Oakwood Park that I mentioned that's up in Lebanon. And up in Lebanon, there's a high demand for affordable housing. The city of Lebanon has been providing subsidies for creating and developing housing, and we've been back and forth with the city officials there several times to understand how we can work together to potentially develop our land. So currently we are evaluating the situation. I think Brett's going to talk about it a little later in the presentation. Next slide, please. So on this slide, we really dive a little deeper into the portfolio. I'm not going to go over kind of each number or through each box, but certainly you can see the pad counts for each park. We have the number of tenant-owned and park-owned homes in the portfolio, which is, so we have 409 occupied pads. The occupancy for each park, as I mentioned before, currently the park is 88%. Currently the portfolio is 88% occupied. Next are the lot rents, and just under that are the market rents. As of today, the lot rents are $30 below what is listed here for each of the lot rents. We have a contract with the seller that he's going to move the rents up $30 before we take ownership. So that's kind of that's what we're reflecting here. But you can also see there's still room to grow our lot rents to simply bring our lot rents up to market. And I would say a big part of our strategy for this portfolio is building back for the water and sewer. This is currently not done at 4 of the parks. So I'd say one of our first orders of business will be to go in, set up Metron meters, and then we'll be able to charge back for the water and sewer at these parks. And then finally, I would say that we typically look to invest in areas where the median single family income price is above 100K and the median income is around 40K. And both of these areas hit our mark and the criteria that we're looking for. Let's go next slide, please. And as we dig, even a little bit deeper into the properties, this chart just simply shows the breakdown of tenant-owned homes, homes that are on the lease-to-own program, vacant lots, and homes to rehab. I'd like to point out here that there are 8 homes that need to be rehabbed, and we have a contract with the seller that they will be delivered and finished by the time that we close. Also, the sellers continue to infill the property during the due diligence phase that we're in right now. So any cost of this with our approval, we're going to be reimbursing the seller for at closing, and we expect the park to actually be over 90% occupied once we take ownership. And it goes to the next slide.
All right, I'll be talking through the whys of investing in Springfield too. Matt alluded to a few with economies of scale and our ability to leverage our existing contractor relationships that we have there. So go ahead, Brett. Just some general MHC advantages. So supply and demand, we know affordable housing is always in need in just about every city, county, municipality. So the demand continues to decrease for mobile home parks in general nationwide, or mobile home communities. Or I'm sorry, the supply decreases, but the demand is always there and it's strong. Recession resistant. So mobile home communities, especially during the pandemic, were top 1 or 2 of the asset types in commercial real estate of rent collection. So over 90%, whereas some like retail, malls, things like that were maybe in the 50%. And so they struggled, where mobile home communities did not. Significant tax benefit. We are able to accelerate depreciation with our properties. Recent example for our Iowa investors, we predicted a 60% depreciation for what they invested. So if they invested $100,000, we predicted $60,000 would be a tax benefit for them, so they would be paying taxes on that. We are actually able to get 80% through our cost segregation studies. So there's significant tax benefits to mobile home communities. Forced depreciation, which we always look for, and typically that is with vacant lots. So every lot we infill, depending on what the lot rent is, increases the portfolio by $40,000 to $50,000. So this one is already fairly stable, but there's still a number of lots that we can fill and force that appreciation. And mobile homes are not so mobile. So a little over 80% of mobile homes, once they are placed in a community, they never move. And part of that is because the cost of moving a mobile home is anywhere from $4,500 up to, we've paid up to $8,000 to $10,000 to move a mobile home. So especially in affordable housing, a lot of our residents don't have that type of cash sticking around. So we say they're sticky tenants. They don't move. So it's pretty stable in that regard. All right. So the 2 main markets, Brett, were you able to get Brendan?
No.
Okay.
Go for it.
All right. So what we look for with our MSAs, our metros, we're looking for a population of 100,000 or more. These are like our gold standard numbers that we look for. Median income, 40,000 or more, and median home price, single family home price, $100,000 or more. So Springfield definitely falls well above, or it's well above those thresholds. a number of employment centers, a number of colleges. There, you see them over there on the right. It's a continuously growing area as far as population and income, which we'll show you here in just a little bit. And then Lebanon, Missouri, go to the next one, Brett. It's only about 45 minutes away from Springfield. Population is less than Springfield, but the other numbers definitely are there. And I would consider it almost a bedroom community of Springfield. So there are a number of housing developments planned for Lebanon that will be breaking ground starting this spring and summer. They're in desperate need of affordable housing. Their two highest employment centers are boat manufacturers. They have a couple boat manufacturers up there. They're known as the aluminum boat capital of the world. There's Lake of the Ozarks. There's lakes down by Branson. A lot of fishing, a lot of recreation, and so a lot of their workers are driving into Lebanon, or they're busing them in. We have great relationship with city officials there that are kind of welcoming us with open arms, doing everything they can to help us with infilling lots and looking into that development of the one park that Matt alluded to in Oakwood that might be 115, 130 lots down the road. So this is an up and coming area for sure, and not far from Springfield at all. Okay. So just a couple of simple graphs here showing the income year over year. So Lebanon increasing pretty rapidly, Springfield increasing as well, and then home values year over year. So Lebanon hasn't had significant housing development over the last few years. So like I mentioned a little earlier, there's a number of housing developments and projects in play that will begin this spring and summer. So the home value should be going up as well as the supply of homes there. Okay, next. Like always, in every area that we look to purchase communities, we're checking demand for those communities. So Springfield numbers, what we do is we place test ads on Facebook Marketplace. So Springfield, it was strong. What we're looking for is 10 or more Google Forms completed within a week, within 7 days. And that shows a strong demand for affordable housing, specifically mobile homes. Lebanon, I turned that ad campaign off after 8 hours, which indicated there on the graph. My phone and computer were just getting blown up. It was actually our strongest test ad that we've ever done. Probably we've done at least a dozen, including like in Detroit, Michigan, where that was our strongest previous to this, which was pretty amazing. So the number of Google Forms completed was super strong, and just a ton of views. People are looking to move there. People are looking for housing there. So very strong indicator that demand is definitely there in Lebanon.
Great, thanks, Ryan. Sorry again for the Zoom technicalities today, but we are surviving here. So this is our business plan. For those of you that have invested with us in our other offerings, what we use this business plan for is sort of our scorecard going forward. So for example, on our other projects we did in January, we did our annual kind of state of the business review, and we actually used the original plans and said, how are we doing? So we showed what progress we've made, things that are maybe behind on, and where we're going from there. So kind of lock this one in your brains and hold us accountable, because we will be showing this to you over the life of the project. So before we close, we've negotiated several great things with the seller. So there are currently 8 vacant homes. All 8 of those will be rehabbed and ready to sell. Side note on this, having 8 vacant homes that need to be rehabbed is pretty incredible on a portfolio this size. Generally, we see a lot more rehabs, and we have even seen some vacant homes that are completely rehabbed and they're not selling. So this is just further testament that there is a ton of demand in this area. So we're really excited to jump in and start selling some homes. Seller will also be infilling lots, and Matt mentioned this a little earlier too. This is a little bit of a unique term that we've come up with pre-closing, but as the seller infills, we'll be approving any homes that they bring in, and we'll also be approving any other expenses. And if we approve them, we'll reimburse them at closing. This is really high value for us, because that means day one, we've got some extra value that we didn't have to wait 6 months for. So that's really great. Finally, the seller is going to be increasing rents before we close. So the other advantage of this is generally we have to give 45 to 60 days notice to increase rents. So that notice will already be done, and we'll walk into this rent increase. I do want to call out, and Ryan and I made this really clear on our previous webinars, we are not the type of people that want to become rich off of rent increases. So when we do a rent increase, we're very deliberate about, is it needed? Is it right? And are we still below market? And so in this case, we're still well below market. With that $30, we want to be the affordable place to be, and also a place that people are proud to call home with the quality of the community. But $30 is still very, very competitive in both Lebanon and Springfield markets. So that all happens before we even close. Year one, we are ordering 24 new homes. So we've built really great relationships with several manufacturers in the Midwest, including Skyline Champion, Legacy, Clayton. And we've already got quotes for getting homes installed within 6 months. In fact, we just are right now ordering a lot of homes for our other communities, and they're all going to be there within 6 months. So first year, we'll have 24 new homes installed. Again, test ads show we're going to do really well with these. We'll also be installing 298 water meters. That is a ton of water meters, by the way. But what's fantastic about this is the water meters we use are all wireless. So we actually get a spreadsheet at the end of each month that shows us all the water usage. And not only is this important for us to be able to bill back water and sewer usage bills, but it's also helpful for us to be able to understand if there's any potential leaks. So we've already been able to detect on other properties leaks just from this data that end up improving our expenses dramatically. So that's going to be a major effort. That'll probably take us at least 6 months to get those installed, because that's again, ton of water meters. And then I've got some specific projects listed here for projects. So Oakwood needs some new roads. It's basically all gravel today, dirt and gravel today. Ivy Acres, we have several. This is actually our main park for infill right now. There's several lots that are covered by trees, so we already have a bid and timing to get those trees cleared, and then we'll come in, and the infrastructure is mostly to these lots, but we still need to develop these lots in some cases with concrete, water, sewer, electric hookups. And then for Cedar Brook, we have detected from various analysis from profit and loss statements, bank statements, all these different transactions for water, that there is a high likelihood that Cedar Brook has a water leak. So we're coming in with the worst case assumption that we need to replace a leak at Cedar Brook. So a lot of our capital, I shouldn't say a lot, but a fair amount of our capital project budget is overly generous in estimating the worst case scenario for Cedar Brook to make sure that we can take care of that water. And once we do, our P&L the profit and loss statement will be much better because we won't have this high water expense. So Cedar Brook's pretty important for that purpose. Finally, in year one, Lazy Acres, we have some lot development to do there with some infrastructure improvements. So all in between year 1 and 2, we're projecting about a $1.2 million capital improvement budget. And so that's already factored in with our debt as well as our equity for the raise and our returns. All of that's factored in with that capital project budget. So if something like Cedar Brook ends up costing less than we expect it to, that'll just be one more thing we can do to return some of the equity back to investors faster, or potentially use that to speed up our home purchases. Finally, and again, Matt and Ryan sort of touched on this a little bit earlier, but Oakwood has vacant acreage where we could develop 110 to 150 new lots. We have this range because we currently have our civil engineers in the area that are working to estimate this for us exactly how many we can get in there, and that will help us really figure out the overall cost of the development. But what we like about this, there's a few reasons why we are interested in doing this expansion. One, Lebanon needs it. Lebanon has a lot of need for affordable housing in that area. Two, there's a very high likelihood we could get a nice subsidy from the city of almost 50%. They've more or less told us that we qualify for the subsidy, and we would just be put on a wait list to do it. So we're currently putting it in year 5 because with this plan, we're saying that it would happen during the cash out refinance stage. So essentially, we would do a cash out refinance and have enough equity from that to be able to go and do this development, plus pay off investor equity, so you would still receive a full return of equity in year 5. However, if we find that we can do it sooner than that, we will come back to the group of investors and do a vote to sort of see what we want to do and making sure that we can do it sooner. I will also say, before we even explore something like this, we always make sure that this will dramatically improve returns. We wouldn't do something like this just to keep the same returns. So this is still TBD, which is why it's purple right now. So happy to talk a little bit more about this if there's some interest. Finally, for timeline and next steps. So our current closing date is May 21st. And so backing into that, we sort of have these milestones we need to hit to be able to make sure that that works. So today, we're obviously having the investor webinar. By April 15th, we need to have all of the reservations due in our Syndication Pro investor portal. So tomorrow, we'll be sending out an email that will have this recording for tonight, as well as a download for this whole deck. You'll be able to see the whole deck. And then I'll also have a link to be able to go in and make a reservation for any kind of investment you want to make. I have reservation in there with quotes because it's a soft reservation. It's not a legal commitment. It's just giving us an idea of something you're interested in. And when we overfill on our reservation, we always go in order of who reserved first. So it's important, if you're interested, to at least give us an idea that you're interested. And then we need the funding deadline will be May 6th. We have to have the funds ready to go a couple weeks in advance of closing for various requirements from the bank. So that's where the May 6th timeline comes in. And then again, we'll close May 21st. So I have a summary of just a little bit more detail of what the steps are to actually invest. So there's a few steps in the investor portal that you'll need to do. If you just go to suncrestcap.com and hit invest, you'll be able to get to our investor portal that way. But we'll also have a direct link to the investor portal. So you'll create or log into your account, make a software reservation, and then review and sign the PPM offering, and then fund investment. Those are sort of those easy steps. One other thing that I've added in here, and the list will be in the list tomorrow when we send out this deck, is we are doing this as what's referred to as a 506C offering. That's a special type of SEC filing, and that requires that all investors be accredited. So this is something we just have to verify accreditation. It's a really simple process, and actually our Syndication Pro tool that we use for funding and tracking returns and everything makes that super easy for you as an investor to do that. So that's something I will personally work with each of you on that process. And then final step is just to enjoy the distributions and the returns. So that's the timeline and next steps. I'll pause for a second before moving on just to see if I miss anything, Matt or Ryan, that you guys can think of that you want to add in.
I think you were pretty comprehensive in that. Matt, anything you can think of?
I think you covered it, Brett. Thanks.
Yep. Okay, perfect. So with that, we are ready for questions and answers. So please jump in and ask us some questions. I've actually responded to a couple already just in the Q&A portal. So let me just really quickly, I see 4 total, 2 that I've already answered. So let me just really quickly recap the 2 that I've received. So the first question that came in was about the 3x multiple versus the IRR. So just we'll quickly explain that. So again, just kind of clarifying, 3x multiple, equity multiple, and IRR are 2 different measures of performance. So they're not, it's not 3x plus 17, it's sort of, you're looking at both. So 3x is another way of saying 300%. So if you invest $100,000, you will receive $300,000 over the course of the 10-year hold period. Again, between cash flow, refinance, cash out, and sale. And then the IRR is more of a equation that is about how or when you're receiving that return. So receiving all $300,000 back at year 3 versus receiving it over time would change that IRR calculation. The next question that we asked was 8% preferred return. Is there hope that yearly cash on cash will be higher than 8%? The answer is absolutely yes. So I went to a little bit more detail on this answer than probably the person was asking for, so apologies for that. But what I wanted to explain was we are still kind of in a phase, and I think most people are watching macroeconomic states of especially the U.S. Fed with rates increasing. So we are very close to be able to lock in our cash flow projections, and we'll publish out what we expect the cash on cash to actually be. But we intentionally omitted it for now because we are waiting for that interest rate sensitivity. So I think we're about a week out from the cash on cash equation. The reason why we're able to quote IRR and equity multiple now is because those are largely weighted on the growth of the portfolio, the value of the portfolio as it increases. And as we improve the operational efficiency, where cash on cash is much more sensitive to the interest rates. So we'll come back to the group with that. But the other piece that I wanted to call out is on this portfolio, 8% goes straight to investors first. And before sponsors receive any kind of cash flow, we have to have paid out that entire 8%. So if we go 6 months without paying this preferred return, that preferred return is accrued. So at the end of, if you invest June 1st, by December 1st, hopefully I'm calculating this 6 months correctly, we'll owe you 4% annualized by then. So, and then it'll just be accrued. And then we'll pay out the first, we'll have to pay out that entire 8% that we owe you that's kind of been backlogged or accrued before anything further can be distributed. And then above that 8%, we split any returns 70-30. So 70% first to investors, 30% second to sponsors. So the scenario I gave in the Q&A section, which I think everybody can look at if you wanted to kind of read through this with me, but if we have 10% total cash flow for a period, and we've already paid out the whole 8%, the remaining 2% of that cash flow, first 70% would go to investors, that'd be 1.4%, and then the other 60% would come to the general partnership team. So that would be a total 9.4% to investors. And that's my way of just reminding you that we are highly incentivized to make this work and make this overperform because we're only seeing that cash flow when we do. Okay, so then there's 3 open questions. Sorry, Ryan, are you trying to jump in?
Nope.
Okay,
I'm just
perfect.
agreeing with what you're saying.
Okay. Okay, so the next question is, what is the purchase price of this portfolio? So the answer is $18.5 million. So it's very big project. Again, that's part of the reason why we brought in FTW Investments is the overall acquisition is just larger than most of our acquisitions. We also recently, we went through a very thorough, probably the most thorough financial analysis we've ever done on a project, where we went back 2 years, analyzed all transactions from all bank accounts against profit and loss statements and income tax statements. And we even had one of our investors is a forensic accountant, and she came in and helped us review all of it, which was amazing. So from all that analysis, we did identify a few transactions that were misclassified. And ultimately, the win on that was that we were able to negotiate a $180,000 seller credit, which will come back and help us out with reserves when we close. So that lowered a little bit of the amount that we needed to bring to closing. So 18.5 million, though, is the overall purchase price. Next question, will the first distribution, does it make up for the whole period of 6 months? Yes, so the first distribution, generally what will happen is we'll do 8% from month 6 on, and then as we get extra cash flow, then we catch up on the accrued percentages. So that first 6 months is still sort of on hold for a few more months beyond that, and then we catch up at, as soon as the cash flow supports it and we feel comfortable with the reserves, then we catch up. Non-accredited investors. Okay, and then another question is to clarify for this offering, there's no share reserve for non-accredited investors. The short answer to that is yes. This is a 506C offering, so all investors do need to be accredited. If you're not sure if you're accredited, please email me directly and I'll figure it out with you. We'll kind of see what options we have. We do have some other offerings right now that do not require accreditation, so that could be an option as well. But my email address is at the end of the deck. It's just Brett, B-R-E-T-T, at suncrestcap.com, and I'd love to work through that with you and just make sure we find the right option for you. Okay, and then the next question, again, what is the purchase price and additional capital raised? So I'm not quite sure the second part of the question, but first part, 18.5 million. We are raising about 5.2 million in equity. So that's between purchase price to cover the acquisition itself and also the capital expenses, reserves, and due diligence and other fees. 5.2 million total in equity.
And Brett, we have another question came across on the chat. The additional pads potentially add how much value if you do 110 pads. So 110 pads, if we're saying it's roughly 50,000 per pad, value wise, it's about 5.5 million. Obviously we have development costs and everything else that go into that, but that'd be my quick answer.
Yep, and I will just say we have done the underwriting on that additional development, and until we completely lock in what the subsidy would be and the costs, it's hard to completely tell you what the value is, or not the value, but the return would be. But our initial projections show that that's a flat return, so it'd be the same whether we do the investment or not. So really, at this point, our plan is to not do the extra development until we see if the city can give us that subsidy and if it really makes sense. So yeah, that's something we may not know for another year, if that's an option or not. But good question on that. Okay. And then we had somebody ask to go through the deal structure. So let me go through that. So we do have this in the deck. So I stopped at this slide that has mine and Ryan's emails. We do have several other appendix slides that we've skipped just for purposes of, it's a long night, I'm sure already, but I've got a couple in here that I will go through. So this is our budget. So we've got debt at 15.8 million, equity at 5.2 million, and then that seller credit that I referenced before. So about 22 million total between debt, equity, seller credit, and then that's broken down over here. So we've got purchase price, reserves. This is our CapEx or renovation budget. Closing and finance costs, this is directly to the bank. So this is an estimate and honestly should be high. I expect this to come in lower than this. And if we are lower, then all of that will just go to pad our reserves more. Due diligence third-party expenses, again, this is also an estimate because this covers our travel to go out and visit the properties. We also pay experts to do surveys, environmental studies, appraisals, things like that all cover that 92,000. But again, I expect that to be high. And then the final two are acquisition fee. This is for our work, our risks, our guaranteeing the loan. And this is basically between FTW and Suncrest, the commission essentially that we have for managing the project.
We have a few more questions in the open.
Okay, cool. Let's see if I can catch up here. Come back. Okay, so we had a question of how many people are we expecting to invest in this? So our minimum investment is $50,000. We do have some incentives if someone is for people investing more than 250,000, where the preferred return will come in at 9% instead of 8%. So it's a different share class, just because it's obviously a little bit more risk for investing a little higher. So that's a little bit of my way of saying I'm not quite sure how many people have invested. We do have some people that are interested in bringing in over $1 million. So if we have a few people doing that, then obviously less than if we have a lot of people doing 50,000. So hard to say, but if I was going to ballpark, I'm going to estimate about 30 to 40 investors will end up being part of this. And I should say as well, I'll take the opportunity to say that our team also invests. So we always take at least 5% of the raise for ourselves that we personally invest our own capital into. And that's our way of, obviously we want these returns, but it's also our way of showing that we have skin in the game. We want to prove that this is something we believe in. Question about investing as an individual or as an LLC. That's challenging. There are tax implications as well as legal liability implications of either one. So I would absolutely recommend you talk to a professional, specifically your CPA, because it depends on the state too. I will say I personally invest, all of my investments are through an LLC holding company. I do that for a number of reasons. To liability, it just also makes my taxes a little cleaner to have it all in one form. But it's really up to everybody. We have quite a few investors that invest individually.
Mhm.
What kind of risks can we anticipate? So also a good question. We do have this in our FAQs. So this, I'll just kind of show this in presenter mode real quick. So the first question I have is any risk. Second question, I guess, technically. So as a limited partner, you're not signing on the loan. So technically, as a general partner, I sign personally on the loan. And so I will invest at least $100,000 personally into this portfolio. So if I walk through as a general partner, if everything goes south, I'm losing my entire $100,000, but I am also on the hook for the loan. So I could lose a lot more than that, including, you know, my house, my car, country song, right? As a limited partner, your entire risk is your investment. So in the worst case scenario, you may lose your investment if everything goes south. But all lawsuits are directed to general partners. And, you know, we have insurance in place. We have liability layers that all protect that, but our limited partners are completely isolated from that. Ryan, did I answer that one okay?
Yep.
That one sounds scary, so I want to make sure that I was clear on that. Okay, the next question, do you accept qualified funds? What is the minimum investment? I'm not sure what is meant by qualified funds. So maybe put in the chat, maybe a clarification there, but I'll try to answer that as best I can. So our minimum investment is $50,000. We do have the opportunity to invest through 1031 exchanges or retirement plans like solo 401ks or self-directed IRAs. They're a little bit more complicated. So if you're interested in either of those, please reach out and let us know. I think that's probably actually what's meant by qualified funds is the retirement. So email me. I personally invest all the time through my IRA, so I'm very familiar with the procedure there. Brett at suncrestcap.com will talk through it. So I'll look forward to hearing from you.
Yeah, I can get this last one here.
Sure.
So the current management in place, we're planning on keeping on. So there's a couple that they live in one of the parks and they oversee and manage 5 of them. And then at one of the parks in Springfield, there's another live-in manager, maintenance man. We've been extremely impressed with this couple. They're very knowledgeable with mobile home communities, with all of the communities around these parks in Springfield and outside of Springfield. They're excellent with sourcing homes, so used homes, finding those. They have a ton of connections with other contractors that we didn't even know about, movers in the area, mobile home toters and such. So yeah, we are bullish on the current management in place and plan to keep them on.
Absolutely. And just further clarifying that, they'll report directly to Ryan as our COO. So Ryan will be very involved in all of those operations, home sales, home infill, everything.
Yep. Okay, I think we got through them all.
I am loving the engagement, though. That's by far the most questions I think I've seen on a webinar. So thank you, everyone, for that. We will stick around for a few more minutes to see if any other questions come up. But is there folks on here? Okay, so Ryan, you see that second question there. So there's no third-party management.
Correct. Yeah, no third-party management. They'll be reporting directly to me. Similar to our other properties, we have a regional management team that we meet frequently, weekly, if not daily, on issues and things that pop up. So yeah, it's a direct line of communication to myself and Brett if needed.
Yep, absolutely. And I will say too, having had some experience with large multifamily apartment complexes, third-party property management can work pretty well with the multifamily space, but it doesn't work quite as well, at least from our experience and the experience from a lot of our other groups that we work with. in the mobile home park space. It's just such a crazy niche that you really got to know what you're doing. And it's also, I think, that old adage of no one cares about something as much as the person that owns it. So we care a lot more than any third-party manager would. So we prefer to keep that close. Okay, a couple new questions came in. Give me a second.
Oh, yep.
Okay. Oh, yes. Okay. Sorry, that took me a second to understand that. Okay. So if 5.2 million is raised, would equity be based on that? In other words, 520K would have 10% share. Yes, that is correct. So 520,000 would be 10% of the raise, and that is what equity is based on. It's a little different because we do have that 70-30 split. So when you talk about the ownership per se, it's especially on the sale and the refi, it's again, everything's we pay off full capital, and then any accrued preferred return is paid off, and then anything above that we split 70-30. So that's sort of where that ownership split could come a little different than that, but the simple answer is yes. Whatever you're going to invest divided by 5.2 is the ownership share.
Yep. And the other question, communication. So Allie, she does an excellent job with communication. So we put out monthly emails, typically minimum quarterly, and we have been doing a quarterly webinar presentation for portfolios as well, just to keep people up to date on how it's going, what we're doing, new projects, challenges. We are as transparent as we can be, because we know not everything goes as well as we plan. So we're happy to share those as well. But yeah, we try to keep as an open and frequent communication with investors as possible.
Yep. And so I will also say, obviously here you have our email addresses. All of our investors also get my cell phone number, so you're welcome to text, call me with questions. But to Ryan's point, we do regular monthly updates over email, and then at least annually we do a webinar, and we do share financial analysis on the performance. So this last year, again, for those of you that have invested with us before, you saw that we showed with our original projections and compared them to actuals, and that's exactly what we do with all of our offerings, and happy to share financials or any kind of granularity that you're interested in.
Awesome questions. These have been.
Yeah, for sure. I think Allie's got her work cut out for her trying to get this out to everybody over email tomorrow.
Yeah.
Okay. Well, with that, just to recap, we will be here to answer questions a little bit longer if anybody else wants to stick around. But these are our next steps. So visit suncrestcap.com if you want an easy way to find our portal and sign in. Otherwise, we'll send the direct link tomorrow along with this webinar recording. And just following these deadlines, the reservations are due by the 15th, and then funding deadlines May 6th. And please reach out directly to me if you have any other questions. The email tomorrow will actually, if you reply to it, it comes directly to me. So look forward to hearing from all of you. So with that, I hope you all have a fantastic evening, and we will see you more in the future.
Okay. Thank you.